Working Man Investor. Today's video, Moody's downgrades the United States credit rating one notch from AAA to AA. Moody's is one of three rating agencies. They provide credit ratings for companies and government securities that they issue. Moody's was the last holdout to downgrade the United States. The Standard & Poor downgraded the United States back in August of 2011 when Congress was having their argument and fighting over raising the debt ceiling. And then Fitch downloaded us from AAA to AA in August of 2023. The reason that Moody's downgraded us is because of our massive deficit. We're $36 trillion in debt and $9 trillion need to be refinanced this year. The way the United States refinances or finances their debt is through the auctioning off of treasuries. So when you, a company, or a foreign investor or foreign country buys a U.S. Treasury, you're loaning money to the government, which is then paid back over time with interest. So in a statement accompanying the downgrade, a Moody's analyst said, if the 2017 Tax Cuts and Jobs Act is extended, which is our base, it will add $4 trillion to the federal deficit, excluding interest payments. Deficit over the next decade. As a result, we expect deficits to widen, reaching nearly 9% of GDP by 2035, up from 6.4% in 2024. Driven mainly by increased interest payments of the debt, raising entitlements spending, and relatively low revenue generation. We anticipate the deficit burden to rise about 134% of GDP by 2035. So what does that last part mean, 134% of GDP? When a country's debt excludes 100% of GDP, the total debt is greater than the nation's annual economic output. This is considered a significant indicator of a country's ability to repay its debt and could signal potential future instability. So this is important because what can happen here is by Moody's lowering us, it could raise the yield on the treasuries, which is simply the interest rate. The way treasuries work is the treasury puts them out to auction and they work in opposite. So the more people you have bidding on a treasury, the more expensive it gets and the less the yield gets. When the yield gets lower, the interest rate, it's cheaper for us to borrow money. So by downgrading the treasuries, you could possibly have fewer people and entities bidding on our treasuries. When this happens, you have to attract more bidders to the market because the United States has to borrow. When this happens, the treasuries get cheaper, all right? So it's cost less to buy a treasury to attract buyers, and the interest rate, the yield, goes up. So it's better for the investors. They can buy the bond cheaper and they get a better return for their money. That's good for the investors. It's bad for the United States because my biggest concern with this is our debt service. We're getting to the point where the only way we really can bring in money is through taxing our citizens and our corporations and tariffs. We're getting to the point here is if the interest rates climb too high that our debt service, we're just going to make enough money through the taxes and tariffs to cover the interest rates. We'll never start to pay down the principal. This, in theory, could bankrupt the United States, even though we're the reserve currency of the world and have the ability to just print money. If you just print money to pay off the deficit, you're going to cause hyperinflation and make the dollar useless. So now it is important to mention here that when this happened for the other two services, it was just a blip on the radar. I suspect that's the way it will continue with this one. But it is still another warning sign. It still goes to back what I've been saying, that at some point here we have to bend the curve. By bend the curve, we got to start running budget surpluses, meaning bring in more money at the end of a year than we spend. We have to start bending that curve, meaning lock our deficit in at 36 trillion, be able to cover the interest payments so that our principal doesn't continue to go up and compound, and then bend the curve by letting inflation, because inflation's here to stay, continue to work on that 36 trillion over the years. That's what some of these people say when they say the Fed wants inflation, which they do, to inflate away the debt, but they don't really explain it. They make it sound like they just want to pay the debt off over a couple of years. That'll cause hyperinflation. If we can bend the curve, stop running a deficit and run a surplus, even if it's just $1 billion a year, and be able to cover our interest payments off of our taxes collected and tariffs, and let inflation work on that $36 trillion, we would go a long way to protecting ourselves as the reserve currency of the world and still being able to sell our treasuries, our debt, to the world. So for now, I do think that this is just a warning, another warning. It's nothing to panic about. I'm curious to see what the markets do when they open tomorrow, see if the 10-year treasury goes up or not on the interest rate. But it's just worth watching and just monitoring. That's what I got for you today. Working man investor. Keep grinding, people.